Good morning, everybody, and welcome to the Balanced Perspective, where we look to discuss the major financial and economic themes taking shape both globally and here in South Africa. My name is David Levinson of Ned Group Investments, and as usual, I'm joined by Iain Power, the Chief Investment Officer of Truffle Asset Management. Iain, thank you for joining us again this morning.
Morning, David, and morning to everyone on the call.
Fantastic. I think, Iain, I did steal from the classic spaghetti western in the title for today's session, The Good, the Bad, and the Ugly. And I think that really I try to capture what's happened in South Africa, particularly over the course of the last month. So I guess the good is we've seen a fair amount of economic reform, a decent movement in terms of the clampdown on corruption. A lot was made at our fund manager workshop of the increase in renewable energy production in terms of embedded energy from 1 megawatt to a stunning 100 megawatts. And then in terms of the bad, we continue to battle a structurally high unemployment, particularly in the youth. And this probably spilled over very much into the ugly, which was the looting and the unrest that we saw about 3 weeks ago across KwaZulu-Natal and Gauteng. And within that, there's a microcosm of the good, the bad, and the ugly as well. In terms of the ugly, the potential sort of sinister cooperation amongst political agents. The bad is the opportunistic criminality, and then the good, I think, is the coming together of communities really rallying around their homes and their shopping malls and their areas, not just during the riots, but in the wake of them as well. So, Ian, I want to take as kind of a broad view for my first question here. We did see 3 weeks ago the Rand come under quite a fair amount of pressure. When the looting and the rioting did kick off, it subsequently reversed some of those losses and it was roughly back to where it was. A bit of risk on risk off sentiment has played out across the globe over the last 2 weeks. But what we saw 3 weeks ago in terms of the looting and the unrest, has that affected your macro view of South Africa in any way and its investment proposition? So yeah, I guess in terms of the guidance for the discussion I was going to host with Iain is his views around the economic prospects for South Africa as well as the investment prospects in the wake of the looting that we saw 3 weeks ago. I know that his colleague Saul, who presented our fund manager workshop, kind of pulled back some of his positive rhetoric on South Africa. But what we have seen after the riots was, which was quite stunning to myself, is a recovery not just in the Rand, but in some of the stocks that would have been most affected. I mean, we've heard a lot about the likes of your ShopRites and particularly your Pepkor, when up to about 10% of their stores were potentially looted. That their share price has obviously dipped initially, but then regained some of those losses and is back to where it ended off, or at least where it started off the month of July. Another thing I was looking to discuss with Iain as well is what the international community's view of South Africa could be. So we saw the likes of Massmart, for example, come under incredible amount of pressure after the looting, and what this might affect the thinking of a Walmart, or at least an owner based in the US, for South Africa's risk-reward prospects, and do they continue with assets like this? There are a few anomalies over the course of the last month. I think the banking sector is marginally where it started. Insurance is slightly down. Property is a little bit down as well, in the vicinity of about 3 to 5%. But the retailers are roughly back where they started, and I'm getting a thumbs up that Iain is potentially back online. So yeah, there were two anomalies in South Africa, which I picked up from a share point of view, and that was Liberty up 30%. That's on the back of some merger or at least takeover talks between Liberty and Standard Bank. And then another one was Imperial, and Imperial has been the talk of an acquisition from DP World, or Dubai Port, I think it stands for, which is a kind of, I guess the wheels in motion for that have been going on for some time, but whether that speaks to, or whether their views might have changed looking in South Africa all the way from the Middle East as an investment proposition. But Iain, I can see your face now. I'm hoping I can hear your voice. Can you hear me
Okay,
okay?
yeah, David. So just to, I don't know if you heard if I finished my last point, but just to say that from a riot perspective, we can expect a deteriorating fiscal backdrop. In other words, more government social support, which I think creates those long-term concerns and perhaps increased risk premium from a foreign perspective around the sustainability of the level of government expenditure, given the pressure on our tax and our fiscus. So I think that really, just to conclude that, I think in terms of your question around local optical value and opportunities, I think you are right, and we've certainly been in the press highlighting the fact that SA assets are looking cheap, certainly versus their history. And I think that's really been evident in some corporate activity that we've seen. in the space. And I mean, you've mentioned Standard Bank taking out the portion of Liberty that they don't own, as well as the fact that we've seen Imperial being taken out by a big US company. So I think the valuations of SA assets are not expensive and are discounting quite a lot of bad news. And I think that margin of safety is positive. And I think it is well for higher, longer term returns for our investors, notwithstanding all the issues. But I think from a country perspective, we really do need to start to accelerate reforms, increase the level of growth so that we can decrease this very high level of unemployment to reduce a lot of those social risks. And we think, that could potentially catalyze the opportunity to extract quite a lot of value in these underpriced SA assets.
Thanks so much, Iain. Yeah, we did lose you for the bulk of that question, but I think you've summed it up quite nicely at the end there. One thing that has been spoken about a lot at typical fund manager style report backs is obviously the strength of the commodity space here in South Africa, and that's supporting our current account. But I want to move a little bit away from that conversation, which is, like I said, been going on for some time, and look at maybe the SA retailers, the likes of your ShopRite, your Woolworths, Pick n Pay, even your Mr. Prices and your Pepkor, etc. I made the comment when I think you were offline, how these share prices actually are back where they started the month of July, despite that initial dip after the rioting. Has that correction surprised you somewhat? Because I imagine the costs of the looting will take weeks, if not months, to repair the damage.
So I think from a financial point of view, many of these companies would have been insured, not just for their premises, but also for loss of profits. So I think from a sort of an impact on the bottom line perspective, that is not really a big issue. I think in terms of the rebuild, particularly from KZN, that's probably going to take quite a bit of time. But certainly the companies will not suffer financially because of their insurance. And I think there's been statements in the media to the effect that the payments or the payouts for damage will be accelerated. So I think that's a positive. And I think also you must remember your opening comments, I think, are relevant in the sense that prior to the looting and that, the economy the domestic economy had certainly recovered quite nicely from COVID. It had delivered a resilient performance. And I think you were seeing that across many of our SA corporates in terms of their results. So, we had seen much better numbers coming through from generally most of the sectors, including some of those retailers that you mentioned. So I think there was already a reasonable level of economic momentum from the recovery that was building. And I don't think it was really a surprise that the share prices have moved up. But having said that, I think the bigger question is really what you said at the outset is the long-term risk premium for South Africa. Are investors reconsidering the underlying riskiness of South Africa or investing in South Africa given what we witnessed? And I think that we will only see over the months and years that lie ahead. But I think we can expect many of those businesses, notwithstanding the riots, to deliver pretty decent earnings updates.
Thanks. And you spoke a little bit about the corporate action. So, Liberty being absorbed by Standard Bank, and that share price came under pressure. We at Nedbank like to follow the Nedbank and the banking sector share prices, but the others all seem to have recovered roughly where they left off. You mentioned, obviously, Massmart being owned by Walmart. So I'm interested to get your views on what an American investor might view of South Africa. Like you say, I think it's probably something that will play out more over the long term. And then you do hold Imperial and DP World have their sights on that stock as well. So maybe some extra comments there on a global view looking into South Africa as its investment prospect.
Yeah. So, David, I think, obviously for us, when we're living through a traumatic event like what we witnessed, 2 weeks ago, is obviously scary and, leaves one with lots of feelings of uneasiness and, I guess, fear. But the reality is, from a global investor's perspective, particularly those that invest in emerging markets, some of the comments that we got back is, these type of events tend to happen. and they can be sporadic, but they do happen. And if you just look across many emerging markets, and in fact some other developed markets, there have been lots of, there's been social unrest, and I mean, maybe, not to the level and the extent of damage that we saw. But I think, generally it's one of the things when you're investing in emerging markets is risks are higher, but then so are the returns. So I think from a foreign perspective, when foreigners look at our market, they're looking at a market where we've, got relatively high levels of infrastructure, and they can use South Africa or those SA assets as, potentially a springboard in Imperial's case, into developing the rest of their African strategy. So I think, still it is a attractive destination from a global investment point of view, and not just from an SA point of view, but in terms of the access that it gives those companies into the broader African geography north of our borders. And I think, also speaks to perhaps the quality of some of those assets in those underlying businesses, for example, in Imperial, which we've sort of spoken about. From a rest of the SA opportunity set, I think, Standard Bank looking at the balance of Liberty, I think that really has been a transaction that's been coming. We've been holders of Liberty in the portfolio, so we had a nice 30% plus uplift in that stock. And they're still buying it at quite a chunky discount to embedded value. But the reality is it was too cheap. And I think they're sort of cleaning up their own portfolio and their own structure. And we think, a sensible transaction for them and for Liberty shareholders.
Thanks, Iain. So we got an email yesterday from the company telling us about the petrol price increases, and I guess we keep a close eye on what that means for the likes of inflation, but also in terms of the South African consumer and how much potential pressure they're under. Because I know we've spoken a little bit about some of the retail stocks. I know you guys do hold the likes of Woolworths, which I think was almost 100 Rand a few years ago, where it dipped below 30, and I think is roughly now sort of 50, mid 50 range, somewhere around there. So maybe just some parting comments on the health of the SA consumer and how this may feed into how one could expect these companies to perform during the remainder of the year.
Yeah. So I think, you've very much got a bifurcated, view of consumer health. So you've got the bottom end consumers, which have been surprisingly resilient, notwithstanding the impact of COVID. And we think, to a large extent, that has been because of the state support and the state grants. And you've seen that come through in the likes of performances from some of those retailers, ShopRite's, even the likes of a Cashbuild and Italtile and Pep's numbers were, pretty good. And I think that really talks to the health of that space, and I think really underpinned by the state support. And then right at the top end, I think, the top LSM consumers also relatively undergeared. If you look at the SA consumer debt to disposable income, and generally debt levels have come down quite a lot. So consumers have quite a lot of capacity on their balance sheets to spend. But I think the big issue right now is the confidence in terms of that. And I think, what you've seen over the last 2 weeks would have certainly put a big dent into people's confidence. And perhaps if there were big investment projects or in terms of new building or renovations and stuff, perhaps people put that on hold for a while. But, generally the consumer, if you look at the consumer's balance sheet, it looks better. And I think to the extent that the state is going to continue to have a transfer of wealth to the bottom LSM, in the sense of what we think is a basic income grant, which is coming, should underpin the health of that space as well. And then finally, our vaccination program is accelerating. And we, really need to use the next 6 months into our summer to make a big dent in terms of getting our population vaccinated. And I think that lays the foundation for 2022, when we could see a proper recovery in the services sector and some of the other areas of our economy, which were very, very hard hit by COVID.
Mm-hmm. Thank you so much, Iain. Apologies for those tech issues. I know we're out of time. I also have it on good authority on avid rock climber, and I know the Olympic rock climbing teed off about 15 minutes ago. So stick the kettle on, stick the telly on, and watch that in the background as you do your work for today. But thank you so much for joining us, and enjoy the rest of your day further.
Thanks, David, and thanks for everyone who took the time to join the call this morning.
Great. Cool. So technology issues aside, apologies you had to hear my voice a little bit more than Ian's this morning. I'm usually scribbling away a few key notes, but I didn't really have the the capacity to do so this morning. But I think the public grants will continue to support the South African consumer, despite the pressure we're coming under. The interesting thing is, I think, in terms of foreign investors looking inward into South Africa, I think their point of view as an investment proposition will probably be realized in a month or two's time. And then the vaccine rollout, Iain had a parting comment there at the end, seems to be being a little bit more progressive here in SA, and let's hope that this third wave that we've seen really does whittle down, and we can get back to economic growth and lower that youth unemployment, which was maybe a big reason behind what we saw in KZN and Gauteng 3 weeks ago. So from myself and the tech team here and Iain and Joburg, thank you so much for joining us this morning, and take care.